Buenos días, hermanos. ¿Cómo están ustedes? Hope everyone's doing all right. Hope your portfolios are in the green and performing well. And if your shares are down, I hope you're buying the dip. I just come back from the gym, so you got to bear with me. But yeah, as usual, I'm very glad you're here. You could have been on YouTube watching anything. You could have been watching a reporter who's having a bad day.
Их не зря так называют. Первые в воздухе, первые...
блядь.
Помолчите, пожалуйста. Первые в воздухе, первые...
Ты будешь со мной, блядь, так разговаривать, блядь, сейчас пизды получишь, черт.
Or you could have been watching another reporter who's having an even worse day.
You'd like to...
Don't you dare attempt to go in my business. Don't you dare.
But anyway, you're right back here with me, so gratitude is my only attitude. Anyway, today's an interesting video. I would like to discuss whether, as people, you should be investing or saving your money. This video is ideally aimed at people who are thinking about entering the stock market but haven't yet pulled the plug. So if you know people in that situation, then please forward on this video. I'm going to keep it very basic, but just giving you some points as to why you should invest your money and not just have it sat in a bank. So yeah, let's roll the credits and get to it. Right, I don't know who needs to hear this video, but I feel there's a lot of people that do and could benefit from it. Because I'm very big on investing your money and not just having it sat in a bank. Because while it's in the bank, you're earning the bare minimum, if anything. A lot of times you don't even realize you're actually losing money through inflation by just having your money sat in a bank. And people are scared to invest. Another thing what I think people need to learn the difference of is trading and investing. I'm specifically talking about investing, not trading. A lot of people, when you mention investing, they're actually thinking of trading and thinking, oh, if I put money into this, there's a chance that a few weeks' time that money's going to turn into nothing. Don't get me wrong, that could happen with investing, but a lot of stuff would have to happen first, where in trading, it can happen like that. So I understand. But I am talking about investing and investing into solid companies where you're gonna earn more money than if that money was sat in the bank, because that's always the aim. When investing in a company, and this doesn't just relate to this situation, this relates to any stock I invest in, there's two goals that I have as a bare minimum. One, it has to beat having my money sat in the bank. Secondly, it has to outperform the S&P 500. Otherwise, you may as well just invest your money into the S&P 500 ETF and have no headache whatsoever. So those are always the two basic minimum things that I'm looking to achieve when I buy into a stock. But what I think would be a very interesting comparison to prove this point to you is what would happen if you invested £1,000 over the course of a year into a NatWest savings account, or instead you invested that £1,000 into NatWest and bought shares. I'm going to show you the money you would make if you did both, and which would be more beneficial to you. Right, so first of all, when making this comparison, I'm trying to look for high interest savings accounts, and I've gone through a few websites, and just for argument's sake, right? So I found NatWest here. NatWest pay 3.04% on one of their savings accounts. See, and you can see it says here for NatWest, 3.04% variable on up to £1,000. And just to be 100% sure, put it in Google, because for the sake of this video, I don't want to get no maths wrong, because you get the maths wrong and the message is completely lost. So £34 you're going to earn on your £1,000 over the period of a year, having your money sat in NatWest. So you put in £1,000, you're going to get back at the end of the year £1,034. Right, so now what we're going to look at is if you was to have bought stocks with that same £1,000, if you was to buy £1,000 worth of NatWest shares. Right, so if I to go to NatWest on my app and go to value, £1,000 gets me 427 shares, 0.78. So let's round that up to, no, let's keep it at 427 shares. So now back on dividend max, we could see that, let's put it in here, 427 shares will give me a dividend payment of £12.81. So we times that by 2, we're going to have just under £26 just from dividends alone. NatWest pay, you see it says here, they're typically 2 dividends per year, excluding specials. So you may even get a special dividend on top of that, which is just a bonus. But let's work off the fact that we're going to get £26, just under £26, just off dividends for the £1,000 you've invested over a year. Now, those figures was based off of 2021 numbers. The 2022, what they're paying out for dividends, price could be higher. Same time, it could be lower. It depends on how much money and profits the business has made and how much they declare they want to pay out for dividends. But you can see here in 2019, they paid a dividend of 3.5p per share. Then the second one was 7.5 pence per share. Then it went down to 2 pence per share. But the second one, no, they had a special one for 12 pence, which is great. Then in 2021, they had one for 3 pence, and the second one in 2021 was for 3 pence. So, you know, basing it on the fact that if it's 3 pence again, those are the numbers, what you should be looking at. So we've established now that off your £1,000, you've already made £26 just off dividend payments, right? So now there's only £8 more you need to find to make it equal to if you was saving in NatWest rather than investing into them. But looking back at this year, if we look here, 19th of October, 2020, so literally a year ago, the share price was trading at £1.22 per share. A year later, today's date, currently £2.32. So you've literally made over 100% off your initial investment. So your £1,000 would now be £2,000 plus what you've made in dividends. Now, that's not to say, I can't sit here and tell you that every year your investment is going to double, or otherwise everyone would just be in this one particular stock. I cannot sit here and tell you that. I can just show you what last year did. But that's just the point I want to make, that, you know, you can settle for a fixed rate with your savings, or if you do your due diligence into your stock and you believe in it, you've got a lot more chance of making money. But also, it depends on the time frame you're working with. Like if you said to me, you know, in exactly a year's time, you are buying a car for, I don't know, 10 grand, I would not tell you to invest 5 and in exactly a year's time you should have 10 grand to go buy that car. It doesn't work like that. But if we're talking long term, and for me long term is anything more than say 2 minimum, but 3 years, then you are much better off investing into a bank rather than saving with one. And when I say investing into a bank, I also mean into other shares which you've done your due diligence on. And that's just looking at things on a basic level. We could go into PE ratios and market caps and all of that, but that's not the purpose for this video. I'm not trying to promote NatWest, for example, as the bank you should invest in. I'm just trying to show you that you can make a lot more money investing than you would saving. Remember, I said at the beginning of this video, my 2 aims are to beat the bank and to outperform the S&P 500. Well, so that's your other option, what you could look at. If you're more looking for stability, then I would recommend the S&P 500. They have their own ETF. So basically, what would happen is you invest your £1,000, and that £1,000 is going to get spreaded amongst the top performing 500 companies in the US. So it's a lot more stable, because if one of those 500 companies isn't performing too well, you've got another 499 that's going to carry it. And the S&P grows every year. You know, we could take a brief look here. You know, that's its performance for a month, 6 months. But when you look at a year, growth. Over 5 years, growth. Maximum growth. So you're going to make more money off of share price appreciation than you will off of the dividends with this particular one. And if we look on Trading 212, 1,000 shares is going to get you just over 1,000 pounds is going to get you just over 16 shares. And 16 shares is going to pay you, they've got it in euros here for some reason, but €3.52 per quarter. But that's not going to be set per quarter, because it does genuinely increase the dividends. You can see here, if we're looking back from, 2015, the dividends have been steadily rising. There has been a couple dips. Like you can see, it went from 20 cents here to 19 to 18, and then back to 20 and upwards again. And the last time they had a dip was 2018. It went from 22 cents back to 21, but then back up to 23. 22, 2019. But to be honest, that's expected with the Rona. I really wouldn't expect their dividend to have maintained throughout. But it's on the rise again. 25 here in 2020, back to 21 in 2020, up again to 24 cents, back down to 22, up to 25. Well, basically, we're looking around the mid-20 ranges. So there's no reason throughout 2022, unless we get another bad dose of the Rona, that, you know, you shouldn't be getting no less than 20-something cents per share. But again, I'm not a financial advisor, and most importantly, I'm not your financial advisor, so always do your own due diligence. But I'm just pointing out that, you're not going to make your money through the dividend here. You'll be getting a nice dividend, but you'll be mostly making your money through share price appreciation of the actual share, because the S&P 500 on average grows between 8 and 10% per year. So by the end of the year, you should have made about anything between 8 and 10% off of your initial investment. But that's not guaranteed, it's just more than likely, but a very high percent. But I hope that video helps. I hope it wasn't complicated. I tried to keep this as basic as possible. But my point that I really want to drive home is, if you're saving for a year in particular and you need that set money by the end of the year, then maybe the stock market isn't the best thing. Maybe you should just put it in the bank for that guaranteed security. But if you're talking long-term savings where you're not going to need that money for a few years, then I strongly suggest the stock market. And that's picking individual stocks if you've done your due diligence and you know what you're looking for. But if you don't know what you're looking for, then the S&P 500 is a nice, safe one to put your money in. You know you're going to get about 8 to 10% on average return on your initial investment and 4 dividends per year. But for that long-term saving, the bank is not the way forward. They're just shafting you. And what you have to keep in mind is, when you put your money in the bank, what do you think they're doing with it? If you go and give them 10 grand, and then you want to come back in a week's time and say you've changed your mind, you want your 10 grand back, don't think that 10 grand's been sat in the back waiting for you to come and get it for whenever you're ready. They've lent that out to someone else and charging them interest on it. They're putting that money into the stock market themselves and making big returns on it. And then they're gonna give you 3%, which is nothing. That's peanuts. When you could be making this money if you just do your due diligence and learn how to pick stocks or ETFs, exchange traded funds, which are slightly more, they are more stable. And that's just really what I wanted to drive home with this one. This video was kind of brought on by a conversation I had with a few people, in particular a friend at work, Adam. So yeah, what's up, Adam, if you're watching? But yeah, I really think people need to look at investing rather than trusting banks. The banks, you know, they're just giving it to you, bruv. We're put into the system where our wages and that have to go through banks, but they don't have to stay in there. Invest your money and you see the big returns rather than them. So yeah, if you found any value from this video, please like the video and share it with someone who you feel may needs to hear this. And subscribe if you haven't already. And if you got any questions, then hit me up in the comments, or you think I've got something wrong, well, let's engage, let's talk it over. But yeah, thanks for watching. Have a good day. Take care of your loved ones and yourselves, and see you soon. Adios.